global diversification isn't as simple as it used to be. For decades, the advice was straightforward. Diversify globally. You want to own US stocks, own international stocks, rebalance periodically, and let diversification do its job. But in 2026, many retirees are asking a fair question. Does international exposure still make sense? Or does it just add complexity, taxes, and risk without enough payoff? This isn't a yes or no question. International stocks can help retirees in some scenarios and hurt them in others. The real issue is understanding what role international exposure plays in your retirement portfolio and how currency risk, taxes, income needs, and withdrawal timing change that equation. Today I'm going to break down whether retirees should still own international stocks in 2026, where the benefits actually come from, where the risks are hiding, and how to decide the right amount, if any, for your situation. Before we dive in, my name's Ryan Knoll, and I'm a certified financial planner and founder of NavWealth Partners, a financial planning firm where my team and I help clients nationwide make smart money decisions. Let's get started. Why does the international stock debate look different in retirement? During accumulation, volatility is an inconvenience. During retirement, volatility can be very dangerous, especially when withdrawals are happening at the same time. That's why asset allocation decisions that work during your working years may need to be reevaluated once income depends on the portfolio you have. International stocks introduce several variables retirees must think about differently. First is currency fluctuations. There's also political and regulatory risk, different tax regimes, dividend withholding taxes, lower transparency, and governance in some markets and higher volatility in certain regions. At the same time, they offer real benefits, such as exposure to non-US economic growth, reduced reliance on a single country, potential diversification during US-specific downturns, and different sector and valuation dynamics. The question isn't whether international stocks are good or bad. The question is whether they improve outcomes for retirees after taxes, after volatility, and after withdrawals. Now let's evaluate the diversification promise and its limitations. International stocks are often justified with one argument: diversification. In theory, owning assets that don't move in lockstep reduces portfolio risk. But in practice, diversification benefits are time-dependent and market-dependent. Over the last decade, we've seen high correlation between global markets during crises, US stocks dramatically outperform in the international markets, and global companies earning revenue worldwide while being US domiciled. This leads retirees to wonder, if my US companies already have that global exposure, do I really need international stocks on top of this? And the answer depends on how diversification shows up and when you actually need it. International stocks may not protect you in every downturn, but over long periods, they can reduce reliance on one economic system, one currency, and one policy regime. For retirees planning 25 to 35 years of income, that still matters, just not blindly. One of the most often misunderstood pitfalls of international investing is currency risk, and currency risk is often ignored until it shows up. When you own international stocks, you're not just investing in companies, you're also making an implicit bet on foreign currencies relative to what the US dollar is doing. This can help or hurt retirees. A weakening dollar can boost international returns, while a strengthening dollar can erase foreign market gains. In retirement, currency swings matter more because withdrawals lock in gains or losses, volatility affects income stability, and timing matters more than long-term averages. A retiree selling international stocks during a period of dollar strength may realize losses even if the underlying companies performed well locally. This doesn't mean currency risk should be avoided, but it does mean international exposure should be sized appropriately and understood clearly. Under the current administration in this country, much of the actions that are being taken are to weaken the dollar relative to foreign currencies. And many foreign markets outperform domestic markets before factoring in the weaker dollar. After adjusting for the currency fluctuations, we saw some of the best returns in years on an international non-dollar denominated investment on a real basis. This just goes to show that you should not only worry about the total return of your investment, but how currency fluctuations actually impact the total return in real dollars. Had the dollar strengthened, we may have seen international investments underperform on an adjusted basis, even though many outperformed the domestic markets on a nominal basis in their own currency. Next, let's talk a little bit about tax drag, which is where international investing quietly hurts retirees. Taxes are one of the most underappreciated downsides of international stocks, especially in taxable accounts. Key issues include things like foreign dividend withholding taxes, lower qualified dividend rates in some countries, reduced tax efficiency compared to U.S. index funds, and limited benefit of foreign tax credits for some retirees. While foreign tax credits can offset some withholding, they don't always fully eliminate the drag, especially for retirees with lower tax liability or those holding funds inside tax-deferred accounts where credits aren't usable. This means two retirees with nearly identical portfolios, one who's US only and one who has globally diversified, may experience meaningfully different after-tax income even if headline returns are similar. For retirees, after-tax income matters a lot more than pre-tax performance. This could be a reason why you want to hold slightly higher international diversification in your retirement accounts as opposed to brokerage. The tax shelter will oftentimes help you avoid foreign taxes while still maintaining an adequate diversification globally. International stocks and income stability is another key issue. We want to ask a critical question here. Do international stocks help or hurt income stability? International dividends can be attractive, but they are often less predictable, subject to currency fluctuations, influenced by foreign tax policy, and paid on different schedules. Compared to U.S. dividend-paying companies, international dividend streams can be more volatile, which matters when income consistency is a bigger priority in retirement. For retirees relying on portfolio income, this volatility may be acceptable in small doses, but problematic at higher allocations. So when exactly do international stocks help retirees? International exposure can be beneficial in retirement under the right conditions. First, we want a long retirement horizon. If you're planning for 30 plus years of income, international exposure can reduce reliance on one country's long-term economic outcome. Next is valuation diversification. International markets often trade at lower valuation than U.S. stocks. This can provide return potential when the U.S. valuations are higher relative to what they've been previously. Third is currency diversification. Make sure you're holding assets denominated in multiple currencies, which can protect purchasing power if the dollar weakens significantly over time. And finally, there's equity diversification within a growth bucket, where international stocks can complement U.S. equities as part of a broader growth allocation, especially when withdrawals are buffered by cash and fixed income. In these cases, international exposure plays a strategic role, not a performance-chasing one. And that's very important. Having a wide variety of equity investments tend to decrease risk. And while decreased risk leads to slightly lower returns, for retirees that should be welcomed because it helps you to avoid large losses due to overconcentration. It helps you to avoid sequence of returns risk on withdrawals and relying on one economy to do all the heavy lifting in your portfolio. But international stocks, they can also hurt retirees, especially when allocations are too large. International allocations amplify currency and geopolitical risk, which can increase volatility at the worst times. Also, when assets are used for near-term spending, selling international holdings during unfavorable currency cycles can permanently reduce income. Next is when tax efficiency is ignored. Holding international funds in the wrong account type can quietly erode returns year after year. And finally, when complexity overwhelms the benefit, when there's more moving parts, they increase the risk of behavioral mistakes, especially during market stress. For many retirees, the issue isn't international exposure itself, it's overexposure without a clear purpose. So when do international stocks belong in a retiree portfolio? For most retirees in 2026, international stocks will work well when they sit inside the long-term growth bucket of the portfolio, are not relied upon for near-term income, are sized modestly, not aggressively, and are placed in the most tax-efficient accounts available. This often means a smaller allocation than during accumulation, emphasis on developed markets over emerging markets, broad, low-cost funds rather than concentrated bets, and clear rebalancing rules. It's important to note that international exposure should support resilience, not increase fragility. With that said, there is a behavioral risk retirees often overlook, and one of the biggest dangers with international stocks isn't its performance, it's investor behavior relative to that performance. Periods of underperformance can last many years, and that's really what we saw for many years up until 2025. As a result, retirees may lose confidence, abandon diversification at the wrong time, and chase whichever region performed best recently. This buy high, sell low behavior is far more damaging than any theoretical allocation mistake. If an investor cannot stick with international exposure through long stretches of underperformance, it may be better to own less or none than to hold it inconsistently. So what's a practical framework that we approach with our retiree clients this year? Instead of asking, should I own international stocks, ask these questions instead. What role does this exposure play in my income plan? Can I tolerate currency-driven volatility during withdrawals? Is this allocation improving after-tax outcomes? Does it meaningfully reduce my long-term risk or just add complexity? And will I manage my behavior? Will I stick with it during underperformance? For many retirees, the answer is a measured allocation, not an all-or-nothing decision, just like it is with much of investing. This is what we find to be a reasonable range, but not a rule. And there's no universal right percentage, but in practice, many well-constructed retirement portfolios will hold less international exposure than you would during accumulation phase, more intentional placement of international assets, and clear expectations about volatility and role. Some retirees benefit from a 10 to 20% allocation internationally. Others may choose less or none, depending on tax structure, income reliance, and risk tolerance. The key, though, is intentionality. And remember, this is dynamic. We still want to adhere to buy low and sell high. This is when rebalancing comes into play, especially within retirement accounts. If U.S. equities perform well, it may make sense to sell some and move it into the international side of the portfolio if it did not perform as well, and vice versa when international outperforms. This is why it is so important to rebalance your portfolio at predefined intervals in retirement. It reduces your risk while also allowing you to follow the buy low, sell high mantra. So what's the bottom line here? Well, international stocks are not obsolete in 2026, but they're also not automatic. For retirees, global diversification must be evaluated through a different lens: after-tax income, withdrawal timing, volatility during distribution, and behavioral discipline. International exposure can help when it's purposeful, modest, and properly placed. It can hurt when it's oversized, misunderstood, or relied upon for income. The goal in retirement isn't to own everything. It's to own what supports your income, longevity, and peace of mind. If you want help evaluating whether international stocks belong in your retirement portfolio and determining the right role and size, that's exactly what we do here at NavWealth Partners. Thank you so much for watching our video, and as always, make smart money decisions.